Accounting is one of the world's oldest business professions, arguably the world's second oldest profession. And yet at the moment, it is in profound transformation. We're going to talk about a new approach to accounting called the integrated bottom line. And we'll walk through these 7 areas. Accountants invented writing, helped create money and banking, double entry bookkeeping, which gave rise to the Italian Renaissance, saved many of the Industrial Revolution inventors and entrepreneurs from bankruptcy, helped develop confidence in capital markets that has underpinned Western capitalism, is central to the information revolution, now transforming the global economy. It was created to enable managers, investors, owners to know the truth about the financial health of a company. But what's on a company's balance sheet is not written in stone as this ancient piece of accounting from Samaria many years before the birth of Christ was written in stone. And we're in the process of reinventing accounting. We need to measure what matters so that we can manage what we measure. This duality runs throughout accounting. But the way we're doing accounting now leaves some things out, these unbooked liabilities, led in part to the 2008 financial collapse. It underpinned the collapse of Enron, which arguably was just doing creative accounting in the best sense of the word, but because they did it in a way that helped collapse the California economy and collapse the pensions of essentially everybody working for Enron at the point at which Enron went down, the accounting firm Arthur Andersen, which was found guilty of shredding Enron documents and trying to cover up what it was they had done, no longer exists. The gentleman at the heart of this, Jeff Skilling, who really was at the heart of this, and Ken Lay, who, because he was the CEO of Enron, was also held accountable. Jeff spent many years in jail. Ken died of a heart attack. This was an enormous collapse of industrial value because of the way that they played with their numbers. We need to give decision makers credible, replicable, transparent methodologies to understand the value that sustainability brings to a company. And we're not counting that at present. We're keeping financial accounting separate from sustainability reporting. But this means that managers are in the dark about the financial implication of the sustainability work that they're doing, unless it shows up as a cost center, in which case they don't like it. We're in the process of developing not separate sets of books, not this triple bottom line of 3 books, which companies aren't going to keep, but an integrated bottom line in which the value of sustainability, the cost of unsustainability, is baked into the financial books that a company keeps. And it's not just a nice to have. In today's world, this will determine your profitability. Profitability. If we counted the real cost to the world of the way in which many companies are doing business, the harm that is being done to the environment, and not just the harm in a moral sense, but the cost to our economy of the loss of ecosystem services, if we counted that, no company on earth would be profitable. This is the result of Natural Capital at Risk, a report from the company TrueCost. We're losing every year close to $5 trillion of economic worth because of the way that we are treating nature or mistreating it. More recently, the Dasgupta report pointed out that although capital, manufactured and financial capital per capita doubled between 92 and 2014, the amount of natural capital declined by 40% per capita. The report said nature needs to enter the economic and finance decision-making the same way buildings, machines, roads, and skills do. The way we do accounting doesn't count the harm that businesses are doing or the value to a company of eliminating that harm, implementing more sustainable practices. And ignoring this harm and value is dishonest accounting, and it leads to bad management. British Petroleum in 2000 rebranded itself as Beyond Petroleum. This was a good step in the right direction. But in 2007, the visionary leader of BP lost his job, not because of the rebranding, but because he lied about being gay. This put the company on a bad course, and so it was not really a surprise when the Deepwater Horizon blew. The then leadership saved $500,000 by cutting some corners, wound up costing the company close to $60,000. 11 people lost their lives. Now, BP survived because they could write off the penalties and costs of the accident. They were tax deductible. In 2020, BP had to write off $18 billion in stranded assets, oil reserves that were on their books that have no value because in a global climate crisis, this stuff isn't worth what they thought it was. You can't dig it up and burn it. And anyway, as we move to electric cars, we're leaving the oil business behind. Here's a company that was trying to make the transition, but because of the way it kept its books, went off the rails. Volkswagen cheated. They said our cars are not putting out these emissions. Actually, they were. The scandal cost Volkswagen $35 billion in fines. The prior CEO will probably go to jail over it, and he probably should. Not understanding the cost of unsustainability has a cost. Uncounted assets. As the world shifts, as we understand the business case for behaving more responsibly to people and to planet, investors and managers are calling for a new way of doing business, looking at the long-term value creation. The international accounting community is looking for guidance in what are the key sustainability performance indicators and how do they incorporate them into financial accounting, not as a separate marketing piece, but baking them into the financial reports. The demand for this will only become more pressing as young people enter the workforce. 83% of millennials say that it is very important to them that companies implement programs to improve the environment. The prior approach, this triple bottom line of economics, environment, equity, or people, planet, profit, was a good idea. Companies need to think about this stuff, but they're not going to keep 3 sets of books, nor should they. But understanding the equity and environment part of how you do business is important. The group Tomorrow's Company says, no, you don't keep 3 sets of books, but you have what they call a triple context in which the sustainable value for the company is found at the intersection of all of these. Ray Anderson, the great industrialist, was one of the first to understand that there was a business case for behaving more sustainably, and that doing that enhanced every aspect of shareholder value. Ray committed his company to zero footprint. He called it Mission Zero. Zero negative impact on the earth. And in his lifetime, Interface cut greenhouse gas emissions in absolute tonnages to the amount that the UN says the world has to do. Cut fossil fuel use, water use, waste. The goal still was zero footprint. Doing this cut his costs, increased sales, doubled profits. Ray also hit on this way of implementing more sustainable practices that we call natural capitalism. First of all, buy time, push back the worst harm that's facing humanity by using all resources dramatically more productively. Second, redesign how you make and deliver everything, all of the products and services, by using approaches like biomimicry and the circular economy. And third, manage all institutions to be restorative and regenerative of human and natural capital. When Ray recognized that everything he was doing was enhancing shareholder value, everything he was doing to implement sustainability, it wasn't a cost center. It was driving his profitability and driving value creation in his company. Ray and I and others started asking, what is shareholder value? What confers an increase in shareholder value? So if you cut your costs because you're eliminating waste, you're using resources more productively, this will go to the bottom line. But it also drives innovation. This may not get captured unless you're accounting for it. It reduces your risks, which makes you more insurable, cuts your liabilities, may even keep the company in business. It enables you to attract and retain the best talent. And in the world of today, talent is what drives profitability in a company. Once you have those good people, enabling them to implement more sustainable practices as part of their day job drives employee engagement. This drives worker productivity, which drives profitability. Gallup Healthways has shown that companies that have higher worker engagement have up to 26% higher productivity, up to 21% higher profitability. Healthier workplaces cut worker absenteeism, healthcare costs. It also drives brand equity, a better market share, product differentiation, enables you to better manage your supply chain and your stakeholder relations. It reduces the cost of distrust. When Walmart implemented its green programs, it cut in half the number of people saying, I will never shop at a Walmart. This has real financial value to a company, but it's not captured by how we do accounting today. A man named Bob Willard took a crack at counting what just a few of these aspects of what we call the integrated bottom line will confer to a company. So if it's easier to attract employees, that takes a percent off your costs. If you don't have to replace employees because they leave, That cuts 2% off your costs. Increased productivity adds 10%. Remember, Gallup Healthways said up to 20% higher profitability. Reduced expenses cuts 5% off. 20% at commercial sites. Increased revenue from better market share, add 5%. Lower insurance costs, borrowing costs, 5%. Bob calculated an increase in profitability of 38% from implementing this kind of integrated bottom line accounting. That's a material number. We took a crack at what would a balance sheet look like if you started to count some of this. The green lines are where we've added things that are not on a traditional balance sheet. So many businesses say our employees are our most valuable asset. No, they're not. On a traditional balance sheet, employees only show up as a cost center, the salaries you have to pay them. What if you could count the value to the company that good employees, higher employee productivity, better retention adds to you? A good green building enables your workers to be more productive. Are you counting that on your balance sheet? Increased brand reputation or enhancement to soil if you're an agricultural company. Conversely, reducing waste or the ability to attract socially responsible investment capital or counting the cost of greenhouse gas emissions or other pollutants. You add all these things into a balance sheet, you get a very different set of bottom line numbers that matter. What's value in today's world? Financial accounting doesn't capture the real picture of a company's value. Increasingly, value is intangible assets. It's reputation, it's brand. Only 16% of value is intangible assets, your desktop, your computers, your factory walls. That's not what a company's worth. This is a projection of the change from 1975 to 2009 in what makes up market value on the S&P, rising from 17% intangible to 81%. That's a big change. Integrated bottom line accounting delivers the business value that gets missed by conventional accounting or by triple bottom line accounting. It moves sustainability from a cost center, oh, we have to pay these people to worry about sustainability, to understanding that it is core to your business value. It gives you a more accurate analysis of how the company is really doing and begins to implement sustainability into the financial DNA of a company. It also gives you a better way to tell your company's story, which gives you the position of being a global leader in this field. Many companies have tried to get at this through what's called CSR reporting, corporate social responsibility reporting. And it's a good thing to do. And as a result, more and more companies are writing CSR reports. 2020 KPMG survey of this found that 96% of the largest 250 companies now report on their sustainability performance. Across all of the companies surveyed, they found that the Global Reporting Initiative was the sustainability framework that best demonstrated this. Again, you can see the growth in ESG reporting by S&P 500 companies. Anymore, it's just what you do. Fewer small companies do sustainability reporting, but a growing number. Here's a company that was one of the early leaders back in the mid-90s, where they said, okay, we're paying for an environmental health and safety department. What is this doing to our overall financial health? They wanted to showcase Baxter's global leadership in this, and at the same time give their management a tool to understand, should we be spending money on this? Should we be spending more money or less money? They came to realize that the avoided costs were about $94 million during the prior 6 years. They tried to understand, what are we saving and what are the costs we're avoiding? And what does this aggregate to year on year? Some people will count 1 year's worth and go, oh, okay, we saved some money. But if you do this year on year on year on year, it gets to be a very large number. Now, this is, yes, an eye chart, but I want you to understand the extent to which they really drilled down into how their environmental protection was adding to the overall company financial health. They had environmental costs laid out, and they had cost avoidance, what they would have had to pay if they didn't have the environmental programs in place. The latter is a much larger number. PoSuM created an environmental profit and loss statement, looked across its supply chain operations in two areas: water use and emissions of greenhouse gases. They're now starting to expand this into looking at social and economic impacts of, are they more or less sustainable? What they found was, if these costs were counted, company would no longer be profitable. And so it was worth investing in reducing emissions of greenhouse gases and in shifting factories around so water intensive activities are no longer conducted in water scarce areas, and they implement water efficiency programs. Their then CEO said this is an essential tool and a shift in how companies can and should account for and ultimately integrate into business models the true costs of their reliance on ecosystem services. Increasingly, companies are recognizing that they have to report at least on their carbon footprint. The Carbon Disclosure Project was created about 15 years ago by a group of kids who said, let's ask the biggest companies on earth what their carbon footprint is. Now, as you might imagine, the biggest companies on earth said, who died and made these guys God? Well, in fact, it was Walmart, who added in their sustainability scorecard that they sent out to their 100,000 plus suppliers a questionnaire. Question number 1, what's your carbon footprint? Question number 2, do you report to the Carbon Disclosure Project? CDP is now backed by 800 institutional investors representing 100 trillion with a T, 100 trillion in assets. And so when CDP asks your company, what's your carbon footprint? You probably ought to answer if you're ever thinking of going to the capital marketplace and looking for investment. So not surprisingly, the number of companies reporting to CDP has come up significantly. CDP also showed that the leaders in measuring and managing their carbon footprint had twice the average total return versus the global 500, and that the leaders had an 18% higher return on investment than the laggards, 67% higher return on investment than the companies that said, we're not going to measure, we don't care. This is a material number. The head of the UK Financial Services Authority said the first step towards managing carbon emissions is to measure them, because in business, what gets measured gets managed. CDP has played a crucial role in encouraging companies to take the first steps in that measurement and management path. Studies are now showing that companies that pollute are valued lower. Companies that lead in cleaning up their pollution are valued higher. Positive correlation between the financial performance of companies and their ability to successfully implement disruptive market innovations related to climate change. This is not fluffy environmentalist concern about polar bears. This is, are you a well-managed company? You need to know this stuff. Better sustainability accounting enables you to understand the return on investment on innovation, how these improvements drive profitability, the value of the reduced costs, the value of labor productivity, of innovation, of increased market share. It allows you to manage in ways that avoid these over-the-horizon black swan events. It enables you to see where your risks are. Increase earnings related to, caused by, sustainability-oriented practices. It transforms stories into quantitative data. And it's from that data that you are able to make allocation decisions. Do we want more of this, less of this? How key is this to our core business operations? It enables you to avoid investing in stranded assets. That $18 billion that BP had to write off, had they stayed the course with Beyond Petroleum, they would not have had those stranded assets. Increasingly, integrated reporting is being mandated. In many countries in Europe, it is already mandated. It enables you to get away from quarterly earnings guidance, which makes you focus only on the short term, not on long-term value creation. It allows you to align compensation structures with achieving long-term value. These are all core aspects of how you manage a business. Sustainability is a fiduciary issue, and sustainable asset management is a key part of how you do business today. The reporting frameworks. The first one was GRI, Global Reporting Initiative. And a growing number of companies use it. As originally put out, it was hard to work with. So a student of mine color-coded and categorized the areas so that it was easier to use. It is the most comprehensive framework, the most commonly used, reasonably flexible. It is, however, complicated, and it's not performance-based. IIRC, International Integrated Reporting Committee, came out of a group called Accounting for Sustainability that was working with the Prince of Wales, calling for connected reporting, how to integrate sustainability into strategy, design business objectives that equate it with overall success, make it quantitative, show the materiality of sustainability, and enable companies to eliminate KPIs that aren't relevant to implementing greater sustainability. And so they sought to embed sustainability into decision-making using 5 key factors: polluting emissions, energy use, water, waste, other finite resources, and simplify the sustainability assessment and reporting, integrating it in a concise, consistent way with the other financial reporting. GRI and A4S then started collaborating, created IIRC. They put out a number of publications on how to do this, taking the business model, strategy, governance, performance prospects, and showing how integrated reporting enables you to manage all of these and give investors, stakeholders, the ability to make decisions in an educated way. So they started with industry analysis, assessed it, monetized the integrated bottom line accounting codes, and then integrating that throughout management reporting. It's formed in 2010 to create a globally accepted integrated reporting framework, bringing together financial, environmental, social, and governance information in a clear way. Set forth the paper on how to do this. And again, give a concise, clear, consistent, and comparable integrated reporting framework. It had a number of values which made it a very attractive framework, particularly picked up across Europe. Pretty graphics about how all of this fits together. What's the relationship of markets and customers to resource use, emissions, performance, investment, etc. They ran various pilot programs, set out the structure of the organization, set out the industry segments that were going to be covered by this. And again, the process of moving from business model to materiality. The core concepts of what needs to be captured in integrated reporting. On the basis of this, South Africa began to require companies to use integrated reporting. And they saw the advent in the United States of a new entity, the Sustainability Accounting Standards Board. The mission of IIRC was to pull all of this together in a way that would become the global framework. And then came SASB. GRI led to IIRC, led to SASB. What we're going to see is that this stuff is on the verge of being integrated into generally accepted accounting principles, at which point, if you're part of an accounting firm, you're going to be doing this stuff. SASB was created with a slightly different framework than A4S, IIRC, and certainly different than GRI. Those were really trying to be comprehensive. SASB said, we're in the United States. In the US, the Securities and Exchange Commission tells companies what they have to report on based on what is material, which means what would a reasonable investor want to know? And so SASB looked at what's useful to an investor. If this is useful to an investor, they're going to look at it. If it's not, it starts to be relegated more towards the moral domain. It isn't said the SEC, something that the reasonable investor would want to know. SASB pulled together industry working groups from all of these sectors, had an advisory council, a board of directors. It then began looking SIC code by SIC code through each of these industrial sectors. The outer ring, the inner ring, they set 10 thematic sectors, 35 industry working groups, considering 89 industries, focused, laser focused on what is material. Material, says the SEC, has been defined by the Supreme Court as presenting a substantial likelihood that the disclosure of the omitted fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. If information is material to an investor, you have to include it in filings like your 10K. It ought to be covered in your financial reporting. SASB said, if we can demonstrate that sustainability is material, that a reasonable investor would want to know it, and that if they didn't know it, this would be viewed as altering the total mix of information made available, the SEC will require companies to begin reporting on sustainability metrics. It'll have to be in the 10K, the 20F, the other financial reports used by investors. And institutional investors will have a fiduciary duty to consider this information. So there is a wide array of information pertaining to sustainability. Not all of it falls within SASB's determination of materiality. Now, organizations like GRI, like IARC, argued, you're leaving out a lot of important information. We may not be able to prove the materiality of it yet, but it ought to be material. SASB said, if we can demonstrate materiality, it's in. So SASB made a materiality map. This looks, for example, at what is material around environmental issues. So climate change, environmental accidents, water use, energy, fuel, GHG emissions, waste. It looked in detail at things like customer health and safety, privacy, board structure, industry by industry by industry. They took this materiality map and developed industry-specific sustainability accounting standards. Again, measuring what matters, managing what you measure. This begins to go into the DNA of a company. Purpose, governance, leadership, talent, value drivers, engagement, reporting, ultimate success. The triple context informing all of this, delivering sustainable value to a company. Manage what we measure, measure what matters. This is the transformation of the accountancy profession. If you want a durable career in sustainability, learn SASB. Begin to integrate this thinking into how you think about accounting. Because all of these different entities, which have been coming at this from a slightly different perspective, are literally as I speak to you, in conversations about harmonizing, about coming together. So SASB has done a deal with IIRC and is in the process of doing a deal with GRI. This is going to be the way that we will do accounting going into the future. You want to be a part of it? Become SASB certified.